$688 billion gone. China just executed the largest sovereign debt sell-off in human history. But here's what nobody's telling you. They sold at a massive loss. Billions evaporated. They knew it would hurt. They did it anyway. Because what's coming is worse. This isn't about trade wars or economics. This is about survival. When the world's second largest economy runs from your debt like a building is on fire, that's not a disagreement. That's a warning. And they're not alone. Japan sold $200 billion. Saudi Arabia's cutting holdings. The entire world is quietly walking away from American debt. The question isn't why they're leaving. It's what they know that you don't. To understand this exit, we need to go back to February 2022. Russia invaded Ukraine. The world expected sanctions. What nobody expected was what happened within 72 hours. The United States and European Union froze $300 billion of Russian central bank reserves. Money Russia believed was untouchable, sitting in accounts in New York and London, became inaccessible overnight. That moment changed everything. Because in Beijing, senior officials at the People's Bank of China were watching, and they understood immediately this could happen to us. Every treasury bond they held wasn't just earning interest, it was a hostage. If conflict erupts over Taiwan, if tensions escalate, America could freeze China's $1 trillion overnight, just like they did to Russia. Imagine keeping your life savings in a bank owned by your enemy. Sure, you earn interest, but they control the vault. They can lock you out any time. That's what China realized they'd done. For 20 years, this system worked beautifully. China manufactured goods, America bought them. China took those dollars and recycled them back into treasury bonds. By 2013, China held $1.32 trillion in American debt. They were America's banker, funding deficits and keeping interest rates low. But after watching Russia get frozen out, Beijing made a decision. Get out, at any cost. Here's where it gets painful. China couldn't just dump everything at once. That would crash markets and destroy their remaining holdings. They had to sell slowly, methodically, but timing was catastrophic. China bought most bonds between 2000 to 2015 when interest rates were low and prices were high. Then the Federal Reserve executed the most aggressive rate hikes in 40 years, from near zero to 5.5% in 18 months. Every existing bond China held collapsed in value. A 30-year treasury bought in 2010 lost 30 to 40% of its value by 2023. Think of it like buying a house for $500,000. 10 years later, you need to sell urgently because the neighborhood's becoming dangerous. But mortgage rates tripled. Your house is now worth $300,000. You lose $200,000, but you sell anyway because staying is more dangerous than the loss. That's China's position. They bought high. They're selling low. Analysts estimate China has taken losses exceeding $100 billion. They accepted this because keeping money in American jurisdiction was riskier than taking the hit. But here's what makes this extraordinary. China isn't broke. They run massive trade surpluses. They have cash. This isn't a liquidity crisis. They're selling because U.S. Treasury bonds are no longer safe. They've become a strategic liability. Let me introduce you to Liu Chen, 42 years old, manager at a manufacturing company in Guangzhou. In 2019, Liu was living the dream. Salary of 30,000 yuan monthly. He'd saved 800,000 yuan for his daughter's education abroad. His parents owned an apartment worth 2.8 million yuan. The family felt secure. Then everything shifted. By 2023, Liu's company faced credit restrictions. Banks were tightening lending. Why? Because when China sells U.S. treasuries, dollars leave the Chinese financial system. Less money means banks have less to lend. Companies struggle. Jobs disappear. But the real blow came when Liu tried to pay his daughter's UCLA tuition, $50,000 per year. He'd saved 15 years for this moment. That's when he discovered the trap. Capital controls now limited transfers to $50,000 annually. His $120,000 in savings couldn't leave China at once. Worse, the yuan had weakened 15% against the dollar. What cost 800,000 yuan now required 920,000. His savings lost 15% purchasing power overnight. His daughter ended up at Tsinghua University in Beijing, not by choice, because the family couldn't afford foreign tuition anymore. His parents' apartment, worth $2.8 million in 2021, is now worth $2.1 million. 700,000 yuan vanished, 30% of retirement wealth. Gone. That's the human cost of currency war. Not dramatic crashes, just slow erosion of dreams, a generation that did everything right watching security crumble. So if China dumped hundreds of billions, why didn't treasury markets collapse? When supply floods in, prices should crash, yields should spike. But that hasn't happened yet. Why? Because as China steps out, someone else is stepping in. The allies. Look at the data. While China collapses toward $688 billion, other holdings surge. The United Kingdom now holds over $750 billion in American debt, nearly tied with China as second largest holder after Japan. Think about that absurdity. The UK economy is 1/6 China's size. Britain runs a trade deficit. So where is the UK getting $750 billion? They're not earning it, they're borrowing it, leveraging their balance sheet through City of London financial engineering to absorb what China dumps. This isn't investment, it's geopolitical obligation. Washington effectively told London, if you don't buy what China sells, Treasury markets break, and if Treasury markets break, the entire Western system collapses. Then there's Belgium. Holdings spiked to over $300 billion. Belgium is home to Euroclear, one of the world's largest securities depositories. When Belgium buys American debt, it's rarely Belgium itself. It's a proxy for other central banks who don't want purchases visible. The pattern is clear. As China sells, G7 nations are forced to buy. Coordinated absorption disguised as normal market activity. But this has a fatal flaw. Allies don't have infinite capacity. China bought endlessly because they earned real dollars selling real goods. The UK and Europe don't have that engine. They're stretched with debt burdens, aging populations, energy crises. By forcing them to absorb American debt, Washington drains liquidity from its own alliance, weakening the periphery to save the core. And China knows this. They're playing attrition. Every billion they sell forces the West to find $1 billion in liquidity. Capital that could build infrastructure instead finances American deficits. China is taking massive losses to exit American debt. But where are proceeds going? This reveals China's true intentions. When China sells treasuries, they receive dollars. But they don't want dollars. Dollars are traceable, freezable, subject to American jurisdiction. So China is converting paper into matter, buying the physical world. Start with gold. China has bought gold every month for 18 consecutive months. Officially, modest purchases. But tracking Shanghai Gold Exchange withdrawals and Hong Kong imports suggests far larger buying. Conservative estimates, over 4,000 tons accumulated in 3 years. They're using bond proceeds to buy metal on London and Swiss markets, shipping it east. Gold has no counterparty risk, cannot be frozen by SWIFT, cannot be inflated away. By swapping treasuries for gold, China moves from credit-based to collateral-based reserves. Then there's oil. China imports 70% of crude. This is their greatest vulnerability. In conflict, U.S. Navy could blockade Strait of Malacca and choke energy supplies within days. To counter this, China's been importing record crude volumes, often from Iran and Russia, paid in yuan, bypassing dollars entirely. More importantly, they're filling strategic petroleum reserves to unprecedented levels. Estimates suggest China holds close to 1.5 billion barrels in combined storage. Satellite imagery shows massive new tank farms and underground caverns. They're building a buffer to survive naval blockade for months, possibly over a year. The money for this oil comes directly from liquidating American assets. Now, consider copper. China's real estate sector collapsed. Construction is down 40%, yet copper imports remain near all-time highs, over 28 million tons imported in 2024. If they're not building apartments, why record copper? Because copper isn't just construction, it's essential for electrical grids reducing fossil fuel dependence, critical for military hardware, drones, electric vehicles, munitions. China's cornering the market on inputs for 21st century conflict economy. They're also stockpiling lithium, cobalt, rare earths, minerals powering batteries, semiconductors, weapons. While the West financializes, China materializes savings into tangible resources that cannot be frozen. And food. China produces 20% of global GDP, but controls only 7% of arable land. Another vulnerability. In response, Beijing accumulated staggering grain reserves. According to USDA, China holds roughly 60 to 70% of world's total corn and wheat reserves, enough grain to feed their population over a year without imports. This is the fundamental shift. A nation planning peace keeps wealth in efficient financial instruments chasing returns. A nation preparing conflict converts wealth into inefficient physical stockpiles. Holding 500 million tons copper pays no interest, costs money to store, negative financial return, but infinite survival return. China willingly accepts lower returns today, ensuring they cannot be strangled tomorrow. This explains selling bonds at losses. Western commentators mock China. They sold at the bottom, destroyed billions through poor timing. This is short-term thinking. Beijing doesn't care about mark-to-market losses in fiat terms. They care about resource security. If they sell a bond at 20% loss but buy oil keeping their economy functioning during blockade, that's not bad trade. That's strategic brilliance. They're trading fake wealth that can be frozen or inflated away for real wealth that can be burned in engines or forged into steel. This pattern repeats throughout history. Britain in 1945 was the dominant financial power. The pound was world's reserve currency. Within 30 years, it was over. The 1967 devaluation devastated savers. The 1976 IMF bailout humiliated the nation. By 1980, the dollar completely replaced the pound. What happened? Britain kept spending beyond means, assumed foreigners would always hold pounds because they always had, weaponized finance. One by one, countries lost faith, diversified, sold pounds, moved to dollars. Transition took decades but proved irreversible. Rome debased currency funding endless campaigns. By 4th century, nobody trusted Roman coins. Merchants demanded gold. Currency collapse accelerated empire's fall. Spain discovered American gold and thought it meant infinite wealth. Instead, flooding Europe with gold caused massive inflation. By 1650, Spain was bankrupt despite owning literal gold mines. France, in 1789, issued assignats, paper money backed by confiscated church lands. Within 5 years, hyperinflation destroyed them. By 1796, assignats were worthless. The pattern never changes. Dominant power prints. Money-maintaining dominance. Other nations initially accept because they must, but eventually trust breaks. Once broken, never fully returns. Collapse isn't instant. It's gradual. Decade by decade, currency loses credibility. Foreigners diversify, reduce exposure, seek alternatives. Then one day, suddenly, nobody wants it. The U.S. is in the slow phase now. China's sell-off is the warning. But warnings are rarely heeded. Those in power always believe this time is different. They believe American exceptionalism means immunity. They're wrong. Empires fall, currencies collapse, systems break. Warning signs always visible to those willing to see them. So what does this mean for you? The assumptions governing investing for 40 years are breaking down. The 60-40 portfolio was built on one idea. Treasury bonds were risk-free, the safe haven, the ballast-keeping portfolio stable. That era is over. U.S. Treasury bonds are no longer purely economic assets. They're political instruments in global power struggle. If China, the ultimate insider, is exiting, you need to ask, why am I staying in? Here's my protocol. Rule 1, shorten your duration immediately. If you hold bonds, understand duration risk. Long-term bonds have high duration. A 1% rate increase causes 20% price drop in 30-year bonds. As China exits and pressure on long rates intensifies, risk is severe. Don't hold long-term government bonds. If you want safety, keep cash and treasury bills with 6-month maturities or less. Almost zero duration risk. You're liquid, not locked into 30-year bet on government fighting financial war. Protocol Rule 2, follow China's example. If they're selling paper to buy physical goods, consider building commodity exposure. Energy, metals, real assets. This isn't speculation. It's inflation protection. Think about endgame. If China dumps remaining holdings and allies exhaust capacity, who buys? The Federal Reserve. Fed will become buyer of last resort. Print trillions purchasing debt nobody wants. When they print trillions, currency value declines and tangible goods prices rise. China knows this. That's why they're buying commodities now. You should consider doing same. Own producers of these assets. If China hoards copper, own miners like Freeport-McMoRan. If hoarding oil, own energy producers like Exxon. If hoarding gold, own the metal itself. Protocol. Rule 3. Watch the allies. Monitor currencies of key players propping this system. British pound, Japanese yen. Japan, largest foreign holder, fights currency crisis simultaneously. If Tokyo must intervene preventing yen collapse, they'll sell treasuries raising dollars to buy yen. If Japan joins China, selling, entire structure faces unbearable pressure. Watch USD/JPY exchange rate. If yen crashes past 160 to 170, or if Japanese bond yields spike, alliance is fracturing. That's when Fed is forced to act. Not because inflation's beaten, but because Treasury market is breaking. The $688 billion figure isn't just a statistic, it's a countdown clock. China is methodically removing itself from the American financial system, clearing the decks, willing to take losses today, ensuring survival tomorrow. Current market stability? Not organic. Held together by political pressure and allied nations' financial strain who have no choice but to comply. When that support falters, and it will, adjustment won't be gradual. It will be sudden, severe, devastating to anyone unprepared. We're living through dissolution of a financial order existing since World War II. Rules governing capital flows, trade, reserve currencies being rewritten in real time. Not through treaties, through quiet, relentless bond selling and accumulation of oil, metal, grain, gold. History doesn't announce turning points with fanfare. It records them in spreadsheets, cargo manifests, central bank reserve movements. Those records, if you know how to read them, are screaming something fundamental has changed. The divorce isn't pending, it's finalized. We're waiting to see who gets the house and who ends up on the street. Make sure you're not holding worthless paper when the music stops.